Hi, and welcome to my YouTube channel, Financial Experts, FinX. Today we are here to discuss a very important banking concept of CMA, also called the Credit Monitoring Agreement Arrangements. This particular document is a very important and common document which is seen while appraising a loan proposal. Now, before we deep dwell into this particular concept, let me introduce myself. My name is CA Anjana. I am a chartered accountant, an author, speaker, ex-banker, and I'm passionate about teaching. I have more than 15 plus years of experience in working in banks, financial institutions, audit firms, and listed companies. I have authored the book From Mud to Amber, which talks about the struggle of a female banker and the ways adopted by her to establish her business. My teaching have helped various bankers in clarifying the banking concept and have helped them in their day-to-day works. I have been fortunate enough to head a particular region as the credit head, and I have come across more than 200 plus credit proposals, be it corporate credit or MSME credit. I have handled a book size of around 3,000 plus crores in a bank. 3,000 plus crores includes both MSME and corporate segments. So now let's deep dive into the concept of CMA. Now, this particular document is submitted by the customer on two occasions. One, when the customer approaches the bank for a fresh credit facility. When we say credit facility, it can be a CC, an OD, or a term loan, both fund-based and non-fund-based facilities. Or this document can be submitted at the time of renewal of the limit. So every year we need to renew the CC OD accounts and review the term loan accounts of the customer. So at the time of review, this document is important. At the time of fresh application or at the time of enhancement of limit, also this particular document is submitted by the customer and it is of great importance. Now let's understand what is the meaning of a credit monitoring arrangement. So what is a CMA? CMA is a document that tells the bank what has been the performance of company in the past and what would be the performance plan for the future. So here CMA has three aspects. One is the past performance of the company, one is the current year performance of the company, and the future year performance of the company. So the past performance of the company, this is how a CMA looks like. What is a CMA? It is the Excel sheet which talks about the past performance as well as about the future performance. Now, as far as past performance is concerned, we can always take the audited balance sheets of the company to find out how the company has been performing in the last couple of years. And when it comes to future performance, the customer or the company would submit the estimations and 2 years projections. Now, when we talk about estimates, what does estimate means? Estimates are the current year financial performance of the company. For example, in this year, we are in the year 2000, financial year 2024-25. So 2024-25 will be treated as the estimated year and projections would be next to 2 years. That is 2025-26 and 2026-27. So these 2 years will be the projected years and 2024-25 would be the estimates. When it comes to estimates, we can verify the sales of the company. We can always ask the customer to submit the GST returns. We can take the GST returns for this current financial year from April to November. And then we can annualize the sales and find out if the company has projected the estimated sales in line with its current year's achievements. So this is what a CMA is all about. So now let's go to the definition again. So what is CMA? It is a document that tells the bank what has been the performance of the company in the past. So this data can be, you can always collect this data using the ABS, that is audited balance sheets, which I have told you. Okay. The current year performance, which is nothing but your estimates, which the company would be providing, and the future year performance. When we come to future year performance, we are talking about the projections. So CMA, so now I hope you understand the definition. So it tells the performance of the company in the past and what would be its performance planned in the future. Now, why is this document important to us? CMA helps the bank in making informed decisions about lending, loan modifications, and credit mitigation risk. By proactively tracking financial indicators, bank can detect early warning signals of potential defaults and take timely actions to minimize losses. Now, let's understand what is an input sheet in CMA, what all sheets are required to be filled. Once we understand few concepts in the input sheet and how a CMA is filled, I'll take you to the format of a CMA. Now, CMA has three input sheets. One is operating statement. This is the first sheet. Second sheet is the liability sheet. Third sheet is the asset sheet. Operating statement, this information can be picked up from profit and loss of account of the profit and loss of the company. As far as liability and asset sheets are concerned, you can always trace the information from the balance sheet. Now, what are the components of input sheet? As I told you, the first sheet, which is nothing but your operating statement. So first, let's look at the components of the operating statements. So operating statement, we have to first input the operating revenue. Now, operating revenue is nothing but the net sales. Now, what is net sales? Net sales is the gross sales minus your excise duty. That would be your net sales. Net sales is further divided into domestic sales and export sales. This division is important for those customers who are in the business of exports. The banks would like to know that what percentage of the total revenue pertains to the domestic markets and what percentage of the total revenue comes from export markets. From the net sales, we need to reduce the raw material and stores and spares. Now, raw material and stores and spares are further divided into indigenous raw materials and imported raw materials. Indigenous raw materials are those materials which are procured within India, and if the customer is importing or buying any raw materials or stores from outside India, that figure would be mentioned in imports. To this, we need to reduce the direct expenses. Now, direct expenses includes power and fuel, labor and wages, and other manufacturing expenses. These are basically those expenses which are incurred in factory at the time of production. And of course, depreciation. When we add the opening stock of WIP, which is nothing but work in progress, and closing stock of WIP, we get the total cost of production. So, to sum up, total cost of production, how do we calculate total cost of production? We will reduce the raw material cost, the direct wages which is incurred in bringing and manufacturing the goods. We will add the opening and reduce the closing stock of WIP from net sales to arrive at the cost of production. To that figure, when we add the opening stock of finished goods and reduce the closing stock of finished goods, we will get total cost of sales. To the total cost of sales, when we add selling and distribution expenses, we get the operating profit. Now, to sum up in easy terms, what is the operating profit? So, operating profit is nothing but the amount of cash that is left in hand after incurring the day-to-day running business operations of the company. See, operating profit, how are we calculating the operating profit? We are reducing our our cost of procurement of goods, which is nothing but the cost of raw materials and stores and spares. We are reducing the direct expenses which are incurred in manufacturing the goods. we are adding and reducing the WIP, which is nothing but work in progress. We are adding and reducing the finished goods and also selling, distribution, and administrative expenses. So after reducing all the production expenses, all the direct expenses, all the administrative, selling, and distribution expenses, whatever is left in hand, that is called the operating profit. But this operating profit is incurred before paying the interest. So we reduce the interest cost. When it comes to interest cost, we need to further bifurcate it into interest on term loans. If the company has availed any term loans, any interest which is paid by the company or the partnership firm or the sole proprietor, that interest needs to be reduced. Interest on CC or OD account, whichever facility the customer has availed from the bank, interest on such payments need to be considered. Interest to unsecured lenders and finance cost. These form part of the interest cost. After reducing the interest, we will get operating profit after interest and depreciation. To this, when we add non-cash and non-operating income, non-cash and non-operating income includes income from dividend, forex gains, and tax refunds. These are generally those incomes which are not directly attributable to business. These do not come from business operations. So that's why these are called non-operating income. In case of any non-operating expenses, we need to reduce the non-operating expenses. We need not add it, we need to reduce it, and that's why this amount, a non-operating expense is shown in the bracket. So when you reduce that, we will get profit before tax. After getting the profit before tax, we need to reduce the provision on taxes to get the profit after tax. Now, let's go to the format of a CMA to understand this better. I'll just share my CMA screen. Please bear with me for 2 seconds. So this is how a typical CMA looks like. The first sheet is the operating statement, which is nothing but OPSMT. The second sheet is the liability statement or LIB-SMT. The third is the asset statement or AST-SMT. As I told you, this CMA has 2 years audited figures, which has been taken from audited balance sheets, the estimated figures of the current year 24-25, and next 2 years projected figures. That is for March 26 and March 27. So this particular statement starts with gross sales. Gross sales is divided into domestic sales and export sales. And then we reduce the excise duty to get the net sales. To the net sales, we actually reduce the cost of sales. Now, how do we compute cost of sales? We take the raw material cost. Raw material cost here, as I told you, it has been bifurcated into imported raw materials and individual raw materials and other spares. Other spares includes import and indigenous spares. To that, we would add power and fuel, direct labor expenses, and other direct manufacturing expenses and depreciation to arrive. And we arrive at the total. To that, we add the stock in progress. We add the opening stock and reduce closing stock to get the cost of production. From cost of production, we add the opening finished goods and closing finished goods to get the cost of sales. To the cost of sales, we reduce the total administrative expenses to get the operating profit before interest. When we reduce the working capital interest, the term loan interest, and other all applicable interest, we will get the operating profit after interest. To this, when we add a non-operating income or reduce the non-operating expenses as the case may be, we would arrive at profit before taxes. To that, we can reduce the provision for taxes to get your profit after tax. So this is what your operating statement is all about. Now, then let's go to the liability statement and the asset statements. So let's go to our presentation to deep dive in the concept of filling the liability statement and the asset statement. I'll just take you to my presentation. So next, we will go to the liability side. So when it comes to balance sheet, we have a liability side and an asset side. So first we fill the liability statement. While filling the liability statements always starts with current liability. Then it will move with figures in term liability. And then finally, the net worth statements. Okay. So what is net worth? Basically, what is current liability and what is term liability? Now, net worth is the promoter's contribution. That is whatever is the money that the promoters have infused in the business is called the net worth. So this net worth includes your equity share capital plus your general reserves in the business plus the retained profits. That is whatever profits are there in the profit and loss account that needs to be included. In case of bigger companies, it will include the securities premium account also. Okay. So this is this would be these are the components of your net worth. When you come to current liabilities are those liabilities which have to be paid within a period of 1 year. Okay. So when we talk about current liabilities, we generally talk about your sundry creditors, because creditors are required to be paid. We need to make payment to the creditors within the stipulated time for buying our raw materials. Then it would be the term loans within 1 year that we are supposed to pay to the bankers. Our CC limits, because CC limit or the cash credit limit is a short-term limit which is repayable on demand. If you go through the sanction letter, it will always be mentioned that any CC or a short-term limit, it will be mentioned it has to be repaid on demand. So such liabilities which are incurred or which are repayable within a period of 1 year would come under the current liabilities. And term liabilities are those liabilities which are required to be repaid, but it are not to be repaid within a period or immediately. It would be repaid sometime in the future. So when you add the current liability and term liability, you get the total outside liabilities. So what is the total outside liability? It is the sum of the current liability and the term liability. Now, then we move across to the asset side. When it comes to the asset side, we start with keying in the figures of the current assets first. Second would be the fixed assets. Third would be the non-current assets. And then we will talk about the intangible assets. So now let's go to our CMA to understand. Let's go to our CMA to understand how are these two sheets, that is liability and asset sheets, being filled. I'll just take you to the CMA. So this is how our CMA is. We have a liability statement first, and this liability statement starts with current liabilities, as I told you. So current liabilities includes the short-term borrowings from banks. In this, we need to mention our limits, our CCOD limits, which we have availed from the bank or banks. In case of multiple banking accounts, we could have availed loans from various other banks. So those limits have to be mentioned here. We have short-term borrowings from others. We have sundry creditors, advance payments which are given to customer or dealer, provision for taxes, dividend payable, and other statutory liabilities. We also have term loan installments which are due within an year, and other current liabilities. So those expenses which do not fall in the above categories can be categorized as other current liabilities and provisions due during 1 year. You can mention the nature of items which are being included here. So this will give you the total of current liabilities. This total of current liabilities should match with your balance sheet's total of current liabilities. Then we go to the term liabilities. Term liabilities in this case includes debentures, preference shares, and term loans. When we talk about term loans, we are going to take only those installments which are payable after 1 year. Okay. Then you have sales tax and deferred tax credit, term deposits, and other liabilities like lease liabilities. That will give you the total of your term liabilities. So then we need to compute the total outside liabilities, which is nothing but the summation of your current liabilities and your term liabilities. After which we need to go to the net worth statement. When we go to the net worth statements, as I told you, it includes all the promoters' contribution. That is all the money that the promoters has infused in the business. So it will include share capital, it will include general reserves, share application money, share premium, and surplus and deficit in profit and loss account. Put together would include your net worth of the company. So when you add your total outside liabilities to your net worth, you will get your total liabilities. This total liabilities must be, this total of the total liabilities must match the total of the liability side of your balance sheet. Then we move ahead with the asset statements. So as far as asset statements are concerned, we start with the current assets. Current assets will include cash and bank balance, FDs with the bank, and receivables. Receivables are nothing but your debtors. Your installments on deferred receivables, inventories. Inventories are bifurcated into raw materials, stock in progress, and finished products, and other consumable spares. After which we have a row for advances to suppliers of raw materials, payment of advance tax, and other current assets. Other current assets, all those items which are not included in the above can be included in other current assets by mentioning the name of the respective items. So this will give you the total of the current assets, and this total must match with the balance sheet total of a current asset. To this, we will add the net block of assets. Now, how do we calculate the net block? We will take the gross block from the balance sheet and we'll reduce the depreciation to get the net block. After which, we need to add the other non-current assets. Now, other non-current assets are those assets which are required, which would be payable in the future, not immediately within 1 year, but would be payable after 1 year. So this would include advances or any investments which have been made in subsidiaries, or other investments or advances which have been given to supplier of capital goods, advances which have been given to subsidiaries, any debtors which is due and payable above 6 months, any security deposits which may not be which would not be recoverable within a year's time, any staff advance, or any amount which is due and payable by your directors. This will also include the intangible assets and deferred tax assets. So this would give the total of your total assets, and this total must match with the total of your balance sheet asset side. Now, after this, as I told you, there are 3 sheets which we need to input. One is your operating statement, liability statement, and your asset statement. After this, we would get some outputs in this balance sheet. Now, let's go to the presentation to find out what are the types of outputs that you would be receiving. Now, let's go to the presentation. So here, once our input sheet, once we have given the relevant inputs in the operating statements and in the asset and the liability statements, this particular CMA would throw out some output details. Now, what are these? The CMA would calculate the financial ratios. Now, financial ratios will include liquidity ratio, asset turnover ratio, return on investments, and debt equity ratios. There'll be a separate video on these ratios. To understand the important concepts of ratios and why these ratios are required for the purpose of credit assessment, a separate video would be posted. It would also take care of your holding levels. Now, what are your holding levels? Your inventory holding level. Inventory holding level is nothing but how many days do you need to stock your raw materials in order to convert it into finished goods. So, what is inventory holding level? It is the number of days you need to keep the raw materials in hand so that it can be converted into a finished product. Debtors collection period is within how many days you are able to collect the money after selling the particular product. And creditors payment days is how much time does the company take to make payment to its creditors. After which we will go to the assessed banking finance. Assessed banking finance sheet. This will calculate the maximum loan amount that a company is eligible, that the bank would be eligible to fund. This is the maximum amount of loan that the bank can fund or the company is eligible for that particular proposal. And then we go to the fund flow statement. Fund flow statement, the fund flow statement, you will come to know that what are the short-term funds and what are the long-term funds in the business and how the short-term funds and long-term funds have been utilized in the business. Here, one important concept is that the short-term funds cannot be used for the purpose of any long-term requirements. If short-term funds are used for the purpose of any long-term requirements, then it amounts to divergence of funds. For example, if we are sanctioning a CC limit, CC limit can be used only for running the day-to-day operations of the business. If the customer takes some amount from the CC limit and if he buys a fixed asset for his business, for which the repayment is, say, 5 years, or if it is more than 1 year, or if he is buying a property out of it, if he has bought a land, then that would amount to divergence of funds, and this is not permissible. However, long-term funds can be used for long-term purposes as well as short-term purposes. So this, to understand this concept of utilization of money, fund flow statement is important. Later, we will also look into the cash flow statement of the entity. To understand this financial ratios and the outputs that a CMA generates, let's go to our CMA format. 1 minute, I'll just connect you to my CMA format. So this is how the liability, this is how the CMA format is. The first sheet is a validity sheet. This sheet is nothing but it tells whether your total assets and total liability columns are equal. If there is any inequality or if the total assets and liabilities of the balance sheet are not matching, then it would be highlighted in the sheet. The second sheet is your financial indicators, performance and financial indicator sheet. This will calculate all kinds of ratios. Like it would calculate profit before tax by sales. So what percentage of your profitability pertains, what is the percentage of your profits to be as a percentage of sales? What are the cash accruals in the business? What are the debt equity ratios? What is the current ratio? And various other ratios would be calculated. Efficiency ratios will be calculated in this sheet. As far as ratios are concerned, I shall make a separate video on calculations of each ratio and why this particular ratios are important in assessment of a particular proposal. The next sheet is inventory and receivables holding level sheets. Here it would be, here the Excel sheet will be calculating that what is the amount, what are the number of days the raw materials needs to be kept for the purpose of converting it into finished goods. So it will include the receivable days as well as the payment days, that is the debtors collection days as well as the creditors payment days. After which we will go to the assessed banking financial statement, in which this particular sheet will tell what is the maximum finance that can be given to this particular proposal. After this, we would be going into the fund flow sheet. Now, this is the sheet I was talking about. It will talk about the sources as well as the uses of the funds. What are the sources of funds? How are the funds being sourced? And what is the infusion? What are the sources of infusion of funds? And how are the funds being used? Here in this fund flow statement summary, we can find out what are the long-term sources and the short-term sources and how they have been used. After which this particular cash flow statements would be given. When it comes to cash flow statements, we have the statement divided into 3 categories. Statement is divided into operating activities, investing activities, and financing activities. This particular statement is important for us to understand how the cash has been rooted in the business. When we add all the 3 operating activities, investing and financing activities, we come across net cash increase or decrease in cash and cash equivalents, to which when we add the opening cash balance, we would get the closing cash balance, which would be reflected in our balance sheets. So, this is how it is. As I told you, in our output sheets, we have discussed about the various financial ratios, holding levels of inventory, assessed banking finance, the fund flow statement, and the cash flow statements. So this is it about the CMA and how the CMA is presented and what are the aspects in CMA and why it is of a great importance to bankers. Thank you for your patient hearing. Do subscribe to my YouTube channel and you can also follow me on LinkedIn. Please do purchase a copy of my book From Mud to Amber, which is available on Amazon by clicking on the link given in the description box. Thank you. Have a nice day.